Hello, everyone, and welcome to the Inside ETFs weekly webinar, Where to Invest in 2018. My name is Saveda, and I'm the Director of Conference Content here at Inside ETFs, and I'll be your host for today's webinar. When we asked 1,000 advisors what they wanted to hear about at our annual big conference, Inside ETFs, the answer was clear. They wanted to know where to invest for the next 3 years. With stocks racing to all-time highs and interest rates on the rise, it's a good question. What opportunities remain in the market today? As we designed the agenda for our conference, we made that question, where to invest, a centerpiece of what we are doing. Today, we're giving you a sneak peek of what we'll be covering down in Florida, bringing two of the key panelists from our highly anticipated macro panel to discuss where to invest in the next year. Lori Heinel is Deputy Global Chief Investment Officer for State Street Global Advisors. She is responsible for a range of activities that impact the effective delivery of investment strategies and solutions to our global client base, including representing our market outlook and investment themes, taking a lead role in investment strategy oversight, governance, and innovation, and managing the implementation of enterprise-wide initiatives. David Bianco is Managing Director, Chief Investment Strategist, and Head of U.S. Active Equity Management for Duche Asset Management. David rejoined in 2012 with 15 years of industry experience. Prior to his current role, David was the Chief U.S. Equity Strategist at Duche Bank and before rejoining at BofA Merrill Lynch and at UBS. We're going to ask David and Lori where, when, why, and how they plan to profit in 2018. But before we do, I wanted to invite Chuck Martin, Portfolio Manager at AGFIQ, to join the call. Chuck was the co-founder, FFCM, which is owned by AGFIQ. FFCM is a Boston-based investor advisory firm with a vision to provide investors efficient and inexpensive exposure to investment factors. We like to bring in innovative firms like FFCM to these webinars to give us a quick 5-minute look at one ETF that we think could be beneficial to clients in the year ahead. Today, Chuck's going to fill that role, talking about the AGFIQ hedged dividend fund, DIVA. Once he's finished, we'll bring in Lori and David to discuss the outlook for 2018. But for now, Chuck, the table is yours.
Great. Thank you very much, Saveda. Very happy to be here today and also with our panelists. So quickly, today we wanted to talk about one of the strategies that we created while FFCM first was an independent organization, and now that we're part of AGF, it's now one of the key strategies that we've been talking about in the last few years. And really, it was created as investors started looking for yield in the market as interest rates were very low for fixed income strategies, and a lot of investors were moving into pure equities. But what that was doing was changing the risk profile of the overall asset allocation. So we were asked, is there something that we could create, given our background in providing risk managed and long-short hedging strategies, to create a ETF that really eliminates a lot of the market risk and sector risk, and at the same time provides a good yield. So that is the hedged dividend income strategy, which goes under the name, the ticker of DIVA. Real quickly, a little bit about AGF. Not a lot of investors in the U.S. know the firm. It's actually one of the oldest and largest independent global asset managers in Canada. AGF stands for American Growth Fund. That was the original fund they created by one of the founders, where they were the first company in Canada to offer access of U.S. equities to Canadian investors in a mutual fund wrapper. The firm currently has about $30 billion in U.S. assets. That's a little bit over $36 billion in Canadian. And it spans strategies from dividend strategies, global strategies, asset allocation, and we helped them get into ETFs last year in the Canadian market and also in the U.S. market where we've had a presence. Really, the firm is diversified across various business lines from both fundamental to quantitative investing, as well as institutional, retail, and high net worth channels. So it's a very diversified company. And at the same time, it's also a public company listed on the Canadian market. As far as the quantitative part of the business goes, that's the part that we are now in. Really, our focus is on providing access to factors and factor-based strategies. We do that through a whole different ways, through both separately managed accounts, through mutual funds, and through ETFs. And those are both in the U.S. and the Canadian markets. We joined FFCM and my partner Bill DeRoche, who we both founded the company about 7 years ago. In fact, it's funny, I was saying earlier to Lori that we came from SSGA, where we worked for about 10 years. And we joined AGF. It was a great fit for us because they already had a fully established quantitative team up in London, Ontario, which is called High Street. So together, we formed the AGF IQ leadership team, which you see here on slide 12, as well as all of the underlying portfolio management and researchers that have a very robust team available, and quantitative investing is purely what we're focused on. So again, it's a very diversified organization, and one that is focused on different avenues of business, as well as both fundamental and quantitative investing. So moving forward, a little bit about why and we created this hedged dividend income strategy. As we've seen and I'm sorry, I'm not sure if the titles were fixed here in this presentation. There's a little overlap there. But the reason why we ended up, creating a lower risk, lower correlation hedge strategy is that investors, again, were increasingly searching for risk as we were out in the marketplace. As you can see, how low the Fed funds rate had gotten, virtually zero, over the past few years after the financial crisis. It's crept up a little recently, but again, there's still quite a bit of excess income that we think we can get out of some of the stable or growing dividend names in the equity markets. While we saw that investors had moved from fixed income into dividend-paying equities, you can see here some of the effects of that, where the valuations of these dividend names actually crept up quite substantially as more and more assets flowed into the space, making that even a riskier proposition for investors who were searching for yield and increasing their risk both from a valuation standpoint as well as from a volatility standpoint. They were trading basically fixed income beta or equity beta, and that was really having an effect on overall volatility in asset allocation portfolios. So our idea was, let's combine kind of some of the best features of what we do in our expertise, and one was factor-based investing. In this case, the factor was really dividends. And secondly, it was being able to run long, short, and alternative portfolios. When we formed FFCM, our first products were long, short, factor-based portfolios, and we did that quite extensively in our prior lives and our prior jobs. And the idea here is that we wanted to create a strategy that generated income from dividend-paying stocks, from growing dividend-paying stocks, but was able to hedge out a lot of the sector and market risk associated with investing in equities. And we kind of saw this as the intersection between growth, income, as well as alternatives. So in the diagram here, kind of right in the center of that. So what we ended up creating was a strategy which we call, again, the hedged dividend income strategy. It is an ETF-based strategy, so we worked with an index provider to create the rules, the systematic rules in choosing the stocks, both the long and the short. The long side is really a basket of stable or growing dividends from amongst the 1,000 largest stocks in the U.S. economy. We limit that to a 25% sector cap. So no sector can be more than 25% of the portfolio. But at the same time, we're going to short out a basket of stocks that have low or zero paying dividends within those same sectors, and we're going to hedge out 50% of that risk. So the strategy ends up being 100 long by 50 short, It has very low correlation to the U.S. equity markets as well as fixed income markets. And very low, and what you can see here is that the long portfolio has a very attractive profile as far as a valuation goes versus the short portfolio. And the net dividend yield on a subsidized basis is about 4% for the SEC yield, and that includes all fees that are associated with running the ETF. So a net yield of 4% with risk profile very similar to the investment-grade corporate bond funds, which is about the mid to high single digits as far as volatility goes.
Chuck, I'm going to interrupt here and say we're going to give you 30 seconds to wrap it up.
Okay, great. So in essence, the strategy has received income from the long side and shorts out a lot of the risk given the securities that are on the short side, and ends up with the overall volatility and risk profile, which you see on page 21. I will say that it now is approaching its 3-year track record this January, and it's done everything that we've expected it to do as far as generating risk and return in dividends for the investor. And that's it.
Thank you.
Turning it back to Savita. Thank you. Sure.
Thank you very much. Anyone interested in learning more should check out the AGFIQ website at agfiq.com. I'm going to bring back Lori and David to talk about the central topic of today's webinar, where to invest in 2018. I'm going to start a big picture with both of you, and then we can narrow down from there. Lori, you first. Big picture. How should clients be positioning their portfolios for 2018? Are you bullish, bearish, or neutral going into the new year?
So in spite of the fact that we keep plumbing new highs in global equity markets, including especially here in the U.S., we are still quite positive on equities going into 2018. And that really rests on a couple of key factors. One is that we are enjoying the most robust global synchronized recovery that we've seen since 1988. So if you look around the world, out of 192 countries tracked by the IMF, all but 6 of them are actually going to grow in a positive direction in 2018. And we think that that creates a tremendous backdrop against which companies can continue to improve their earnings. Now, we don't say this without a little bit of concern. I mean, clearly, as we look at valuation levels in places, especially like the U.S., they are quite stretched. But here again, we think some of the impact of tax reform, which just passed and got signed by the president today, will actually add about 0.5% to perhaps as much as 0.8% to U.S. GDP. So there again, we think the conditions are quite good for equities on a global basis.
David, what's your view of 2018? Is it time to pare back exposure, or is it time to step on the gas?
Not pare back exposure. Don't step on the gas too aggressively, but we're overweight equities. We're constructive on equities in the U.S. and abroad. We're suggesting a 65% equity allocation, 30% allocation to fixed income, including cash, and 5% to alternatives. We would describe ourselves as being overweight equities, and we've got about half of our equity allocation to foreign stocks, emerging market stocks being one of the areas where we think is the best chance to still get double-digit returns. We're expecting returns to be more mid-single digit out of the U.S., both U.S. large caps and small caps, and I think in 2018 you have a lot more narrow of a dispersion in performance across sectors as well as across styles like growth versus value. We're constructive, agree that the global economy is healthy and it's in sync. U.S., Europe, Japan, China, India, all growing at a good pace. And we think inflation stays contained, and we think interest rates only climb gradually over the next couple of years. We think it's most likely that the 10-year Treasury yield stays below 3% for the rest of the cycle. And we do think this is going to be a long-lasting economic expansion that sets a new record, goes through 2019. So good growth. I'll get to some earnings numbers in a minute for the S&P, but good growth with contained inflation and just a gradual climb in interest rates. from low levels. We do think these PEs are justifiable, albeit high versus history. We think they're fair and justifiable. And if the 10-year Treasury yield doesn't get to the 2.6% that we're forecasting by the end of 2018, we think we really need to think about an even higher PE. But we're using an 18.3 PE on the $150 of earnings that we're forecasting for the S&P in 2018. 18.3 times 150, that's 2750. That's our target for the S&P at the end of 2018. The $150 of earnings is about 15% earnings growth from the $131 that the S&P should generate in 2017. So $19 of earnings per share growth, 15%, and about $10 is coming from the corporate tax cut. And about 7-8% is coming from the corporate tax cut. And that's inclusive of some of the benefit that we also expect from buybacks. We do expect buybacks to pick up. We do expect that to shrink the share count. It's not going to cause the share count to fall in a big way, but rather than shrinking 1.5%, maybe it shrinks 2.5% in 2018. I do think that dividends are increased along with the higher earnings out of the S&P. We're expecting $55 of dividends per share. That's 12% growth in dividends. And one of our big messages is that financials, big banks, should lead this dividend growth. And when we think about many of the themes that are out there, financials seem to be the biggest beneficiaries. We do think the U.S. economy is in good shape. We do think the Fed hikes. We do think that these deregulation trends are helpful to banks. And this corporate tax cut's a big help to a very domestic, high tax rate industry like big banks. So one of the things that we think is going to be something worth overweighting of U.S. stocks is big banks. We're still overweight big banks. We're underweight energy. But even though we think financials will be the best performing sector in 2018, we think there's still more gas at tech and healthcare, at some of these large cap growth stocks. So we're not expecting a big rotation from growth into value. We're thinking just growth outperforms more modestly in 2018 and 2019, but we do think within value, financials outperform and particularly outperform energy. So that's our thoughts.
David, I'm going to keep it on you, and you're head of active equity management. In 2018, is 2018 a year for active funds, or is an index approach still the way to go for most investors?
Yeah, when I think about active and passive, I think what people need to realize that when you think about this thing strategically or over a long period of time, they go well together. We are trying to do our best to generate outperformance, alpha, but we're trying to do it in a reliable way with a low tracking error, high information ratio, and we're trying to do it as much as possible in an uncorrelated way, uncorrelated to the benchmark, so we're not momentum chasers, and uncorrelated to other alpha strategies. That way, we may not be your only alpha manager, but over time, I think active and passive strategies belong together. But, over the short term, I do think 2018 is going to be a good year for active. It was in 2017, too, after a long time of active not outperforming. And I think when you think about when conditions are ripe for active to do well, it's when you have a less of a macro-driven market, and fundamental stock pickers can get back to doing what they do best, picking stocks. So we see this volatility having come down in the market, getting less pushed around by macro trends. No one is really worried that much about recession or big inflation, or think about the commodity and currency swings that we've gone through in 2015, 2016. I think it's a good environment for active managers to do what they do, and we think 2018 will be good.
Lori, what about you? What do you think?
Yeah, I would agree. We too have written a lot on the idea that as correlations have come down, dispersion has increased both across asset classes as well as within asset classes like equities, that certainly provides the conditions for active managers to do well. Historically, also during rising rate environments, active managers have done better. So we do think, as David mentioned, this creates the conditions for active managers to be able to add incremental value. We also think, though, that in many cases there are certain markets, EM for example, where getting access is the most important thing. So oftentimes, if you're looking at something like EM debt or emerging markets debt, there are a lot of constraints around how one can access those markets. There are a lot of costs attached to accessing those markets, and then paying incremental active fees on top of that may erode the value of an active manager. So one has to be selective, and I would concur with David that it's not either or, but it's actually both. They both have their place. They both can help to manage the overall fee budget that a client has, and they can also be used in a way that can let you get access to markets as well as extract that incremental alpha that might be available.
Okay. Well, and taking us into a different direction, do you have any worries that we're in a massive bubble right now? We have Bitcoin going to the moon. You have VC red hot. Is it the Bitcoin Silicon Valley bubble, the canary in the coal mine that we're overheated about here?
So I think the word bubble gets tossed around very loosely, right? So if you think about bubbles, they typically are scenarios where an asset's price has become so disconnected from reality that it doesn't appear that there's anything fundamental that justifies the price level. So clearly, if you look at something like equities, as both David and I have mentioned, against a backdrop of strong global growth, against a backdrop of improving earnings, even while valuation levels may seem stretched in certain environments, such as U.S., for example, they certainly are justifiable given the likelihood that earnings will keep pace and to actually accelerate in here, and that there is actually something that underpins the valuation. And then similarly, I can remember not that long ago people talking about a bond bubble and carnage in the bond markets. Here again, the downside in bonds is you get your principal back. That's hardly a bubble kind of territory. Bitcoin, we're not necessarily trafficking in Bitcoin right now. I think the biggest challenge with something like Bitcoin is to think about what's your paradigm against which you would evaluate the value. So if you think about something like, what's the volume of transactions that might be conducted in Bitcoin, and how would the value of the Bitcoin at, sort of at its limit in terms of the number of Bitcoin out there, what might that look like? We think that there's opportunity to think about how to value those sorts of things, but right now they do seem as though they've just been trading on enthusiasm and momentum rather than fundamentals.
I agree with Lori. She said it very well. And Bitcoin aside, I don't see bubbles. I would agree with the idea, however, that there's still a lot of uncertainty in what are neutral or normal interest rates. Where the Fed plateaus and where the 10-year Treasury goes, these are still big questions. And I think we're all surprised at how low interest rates still are, and that's something we really need to keep an eye on. I don't think we have a bond bubble, but we're at the stage where we need to be a little bit more precise in where we think normalized interest rates will settle and be, because I do think that the S&P 500 is basically trading on a 3% 10-year Treasury yield, 1% 10-year TIPS yield, and right now we're well below that, but we expect yields to rise as the cycle goes on. So the point is, keeping an eye on interest rates and making sure that they don't go up too much is going to be an important part to supporting these valuations that we see in the equity market and other risk assets.
Let's take it to emerging markets. I know, Lori, you wrote an article about going to China. So is it time to go to China in terms of actually having a poised, stronger year there?
China's a really interesting story, and we've been quite bullish on China for a while, and I think the combination of the political stability coming out of the Congress, as well as the aspirations that China has to be a more significant global player from an economic and financial standpoint, we think that sets them up for really a decade of interesting investment opportunity. Again, not without its concerns, but keep in mind a couple of key factors here. Even growing at 5 or 5.5%, China's now a $1.1 trillion economy. It is contributing a third of the incremental growth globally. The region, which includes China, is contributing nearly 70% of the incremental global growth globally. So you can't ignore China. The other thing that's important to remember is that it's an enormous consumer class. So there are now 100 million middle-class consumers in China. That's more than we actually have here in the U.S. So as a consumer class, it's the incremental opportunity there is enormous. Again, there are issues. I mean, certainly debt levels are something that we watch very carefully, but here again, they've got the policy tools as well as the surpluses, the current account surpluses and other surpluses to be able to deal with those things. So we think China could be a very interesting place to be, and there are some really great companies in China as well.
David, I'm going to ask you this. What about India?
Okay.
Because I know you mentioned India. Aren't the demographic trends in India stronger than they are in China?
Okay, so good question, and we are overweight emerging market Asia, both China and India. When we look at the economy, we actually expect China's economy to decelerate a little bit, still do more than 6% growth in 2018, but decelerate. And India is one of the few regions where we expect there to actually be an acceleration in their growth. But, I'd make the point that I think we're getting, when you look at, this has always been the case for the U.S., and many investors could appreciate this. The economy is not the same thing as the stock market. And I'm not just talking about, anticipating where valuations are going to go, but also the underlying earnings power. And while economic growth provides companies an opportunity to make investments for growth, to reinvest capital, you have to see how good their business model is and what type of return on capital they're actually earning on their reinvestment. So when we look at China, particularly some of these large cap, mega cap technology companies and increasingly more consumer and even healthcare businesses in China. And India has always been one of these emerging markets, one of the few emerging markets that has many more industries beyond the basics, commodity production, banking, telecom. What we like about China now and what we like about India now as well is that these are companies that they're actually growth companies in the sense of they get good return on capital, differentiated business models. And when you look at emerging market Asia, the return on capital, return on equity is better than Europe. It's far better than Japan. And these businesses, when you look at these indices stripped out of banks and their commodity producers, they're getting returns on equity that are becoming comparable to what the S&P earns, high teens. So we like the businesses. So I'm happy to talk more about China and India, and I don't want to downplay that, but we like the businesses. That's the real new thing about what's making emerging markets, particularly emerging market Asia, different to us this time versus the past when usually emerging market stocks were about view on currency, commodities, or just strong macro trends. This is about the businesses.
And this is Laura. I would just jump in there as well. I totally agree because, first of all, you have world-class companies that are now exporters globally that are domiciled in these economies. And then you also have local companies that are catering to the needs of the locals, whether it be education companies in India or food services companies in China and Russia. And there was once upon a time there were concerns about the quality of some of these companies and their goods and services, but those things have been improving pretty dramatically. So I think that's spot on to say this is about the companies, not just the economies.
And we're going to end with one final.
Sure.
Well, we're just going to end with one final question. How should investors worried about downside protection be positioning their portfolios?
Look, that's a really tough question because investors who have been worried about the markets and stayed in cash or positioned in bonds, they've really missed an incredible rally here. So, the obvious ways to get downside protection, things like, puts and things of that nature are quite expensive. So the way that we try to counsel our clients is, first of all, don't think in terms of weeks or months. Try to think in terms of years. So get your strategic allocation right at the margin. Tactically allocate a little bit to where you think there's going to be better growth. Also, within an asset class, think about more defensive ways. So we heard a discussion earlier about, more dividend-oriented. And again, that was more of a long-short type of a strategy, but a place where you can get more dividends or have a bit more defensive characteristics. Active management, where there again, there's more of a focus on risk management within the portfolio, along with accessing the alpha opportunities. So those are a couple of key things that we would be looking at. And then the diversifiers. Look for places like long bonds, like gold, gold, like managed futures, other asset classes where you can have a little allocation and that can protect you in the event of a downdraft.
That's right. Diversification's key, and while nobody really wants to buy 10-year Treasury yields at 2.4, these things are bought for the risk hedge. If things go wrong, yields will very likely fall. So, keeping fixed income, high quality, long duration fixed income in the portfolio it still has its place. And even investment grade credit, it's not it doesn't protect you against a recession, but it does protect you against deceleration. And maybe as the cycle goes on, we get some deceleration. So fixed income has its spot in the portfolio. It's an important diversifier, and that's what we would suggest people do.
Thank you both very much. Well, that just wraps it up for us. Again, I'd like to thank our panelists, Lori Heinel and David Bianco, for your time and thoughtfulness today. We really appreciate you sharing your views. I'd like to thank Chuck Martin for coming on the webinar today to share his thoughts on the DIVA ETF. If you want to find out more on that ETF, just visit their website at agfiq.com. I'd like to thank you, the audience, for coming to this webinar today. We know your time is valuable, and we appreciate the commitment you show to your clients by continuing your education on ETFs. And of course, if you want to hear more from our panelists today, please join us down in Florida for the 2018 Inside ETFs Conference. You can find that conference by Googling Inside ETFs. Space is filling up, but there is still room to register. The Inside ETFs weekly webinar is off next week, but we will return after the holidays. For now, we wish you a great year end and a fantastic 2018. Thank you so much.